Hey, what's up? What's up? What's up, my Financial family? Hopefully all is well. Hopefully all is well. If you're not familiar with my channel, my name is Christopher. This is a financial consultation session that I like to do for free once a week for my all my listeners and all my subscribers. If you're not familiar, the purpose of Financial is to teach people how to make money, how to save money, how to invest money, how to build generational wealth. Okay. And I thoroughly enjoy doing that. To me, I've kind of find that when you teach a person essentially how money works, how money operates, and more importantly, you teach an individual how to financially free themselves from this system that basically keeps us enslaved and enchained to debt. People literally change the entire way they live their life. I've seen women leave abusive relationships when they realize that they have value. And when they realize essentially how to invest their money, they understand the 4% rule, the power of compound interest, and the fact that if you learn how essentially how money works, you don't have to tolerate a man hitting you and cheating you disrespectfully. I've seen men who are also in abusive and ridiculous relationships where they have a person that literally disrespects them every night, cheating on them every night, and who pretty much has no respect for them. I've seen men literally once they figure out how money actually works and essentially that they don't have to live paycheck to paycheck, they don't have to be addicted to credit card debt, and they don't have to try to wine and dine people who never respect or love them. I've seen men literally change the entire way that they allow women to treat them in their relationships as well. So one of the things that I love about teaching financial literacy, everybody, is that it frees a human being up in so many different ways when they no longer have to worry about money. When you understand how money works, you don't stay at toxic environments where you're getting cussed out and mother effed every day at work. When you understand how money works, you don't stay in abusive relationships where you're being verbally or sexually abused, essentially, by a partner. When you are in relationships and you're being physically attacked, essentially, by an individual who you quote unquote lay next to every night, I've seen people and they figure out how money actually works and the way to make money work for them and for themselves and for their kids and for their family. They walk away from those relationships. So at the end of the day, everybody, financial literacy is a lot more than just quote unquote making a lot of money and stacking a lot of paper. It's literally about freedom that goes vastly beyond, I would just say, money and vastly beyond how big your bank account is and how nice your clothes are and what kind of car that you drive. So in this particular podcast tonight, everybody, I want to talk about in this particular live session tonight, everybody, I want to talk about financial habits that are keeping you broke. And I also want to talk about what not to invest into. Okay. Once again, my name is Chris. I am an MBA. I'm a mechanical engineer with this MBA, and I thoroughly enjoy people teaching people once again how to make money, how to save money, how to invest money, and how to build generational wealth. So yes. So the first thing I'm going to tell you guys to not invest into, everybody, is whole life insurance policies. Now, this is one of the ones that's kind of somewhat, for some strange reason, a little controversial in the finance community, and I don't really, truly, honestly understand why. Because when you actually sit down and understand the way investing actually works and the way compound interest actually works, there is no permanent need for life insurance. And what do I mean by that? If you have a fully stocked 9 to 12 month emergency fund, if your kid's college fund is paid for, if you have no credit card debt, if you essentially have no high interest debt, if you essentially have a career that pays over six figures, or in some cases even pays $50,000 a year, if you meet the other things I talked about earlier, if you have a compound interest, if you're maxing out your 401k, if you're maxing out your HSA, if you're putting money, if you're maxing out your Roth IRA every year, there is no permanent need for life insurance. And what do I mean by that? I'm glad that you asked. Think of it this way, everybody. So let's say you get a permanent, let's say you get a whole life insurance policy, everybody, that pays you $1 million a year when you die. And let's say you die essentially at 70. And let's say you start investing 600 or $700 a month into this $1 million life insurance policy when you turn 30. That means if you die at 70 because you have a 40-year life insurance policy, you essentially spent 40 years, everybody, paying $700 a month for a $1 million a month life insurance policy. And the reason why I say $700 a month is because if you take a look at smokers, you take a look at individuals who are unhealthy, or if you take a look at individuals who are healthy, a decent life insurance policy is going to run you about $500 to $700 a month. So let's just say $700 to keep the math easy, okay? So if that's the case, you spent 40 years paying $700 a month for a whole life insurance policy. And when you die, you essentially can give $1 million to your loved ones, to your wife, your kids, and your grandchildren. On its onset, it sounds like a pretty decent idea because at the end of the day, if you are a responsible man, woman, or a husband or wife, you're a real man, you are going to want to leave some kind of nest egg, some kind of I would say retirement thing to your children. If you're a real man, that is. you are a loser and you essentially do not want to do that, however, you may be in a situation where you don't want to do that. And if that's the case, that's extremely problematic. Okay. So let's say in this particular example, right? You don't want to leave any, let's say in this particular example, you leave $1 million to your loved ones at 70 years old. And that's an honorable thing to do. All right, that's the way they essentially brainwash and teach us doing capitalism. Put $700 a month into this life insurance policy, and if you do that, well, when you die, you're taking care of your family. And to some extent, I kind of see where people are coming from. Once again, it sounds nice, but let's kind of rethink this policy, okay? Because when it really boils down to it, if the industry is pushing things from a financial perspective, I want you guys to seriously sit back and say, why? The industry right now is pushing forex. Why? The industry right now is pushing meme coins and Dodge coins and Bitcoins. Why? The industry right now is pushing nothing down real estate. Why? And the industry right now is pushing whole life insurance policies. Why? So let's think about this a little differently, okay? Let's say that you instead spend $100 a month for a term life insurance policy. And you spend 40 years essentially, you spend 20 years instead, everybody, actually investing $100 a month into a term life insurance policy that also pays you $1 million a month. And once again, remember I said earlier, there is no permanent need for life insurance. Well, get this. If you spend 40 years, everybody, investing $600, and the reason why I say $600 is because you spend $100 a month essentially for 20 years into a $1 million a whole term life insurance policy, and you invest the other $600 into good growth stock, total stock market index fund that has a good dividend ratio, everybody. So you spend 40 years putting $600 a month into a good total stock market index fund that returns roughly 10 to 12%. So let's say 10% in this example, everybody. By the time you retire at 70 years old, by the time you die at 70 years old, you would have 6 million with the M dollars in that same policy. So what makes more sense? To spend 40 years investing $700 a month into a whole life insurance policy, and then when you die at 70 years old, you only leave your family $1 million, or to spend 20 years investing $100 a month into a term life insurance policy. Then once you become self-insured, you spend the next 40 years investing $600 into a total stock market index fund. And when you die at 70 years old, you leave your family 6 million with the M dollars. I sincerely hope you believe, and sincerely hope you came to the conclusion that leaving $6 million in your family is better than leaving $1 million in your family. So, once again, there is no permanent need for life insurance. That is a lie that is told by the insurance industries, and they do that because it allows them to send their kids to college, and then for them to basically retire in 7, 8 bedroom homes while they're selling you absolute garbage. Very, very few term life insurance policies can return over 5%. But for some strand, and the stock market routinely returns on average about 11%, and the S&P 500 has returned 12% over the last 50 years. So why in the world are you investing into a policy that only returns about 4 to 5%, when you can be investing on your own into a good total stock market index fund, or a good ETF, to a good real estate investment trust that has averaged roughly 10 to 12% over the last 50 years? There's no permanent need for life insurance, everybody. Now, do not take what I'm saying as that there's no need for life insurance, because there is a tremendous need for life insurance. But the type of life insurance that I'm telling you guys to invest into, everybody, is term life insurance. And the reason why, as I said earlier, it is a significantly better investment. These investment policies, everybody, for whole life insurance policies, they typically do not grow at the same rate as the stock market. The insurance premiums in many cases are roughly 15 times higher. And what's even sadder is that with a lot of these policies, you spend roughly the first 80% of the policies themselves actually paying fees and paying commissions for individuals who don't care anything about you. So, first investment, everybody, that I want you to completely avoid are whole life insurance policies. It is a vastly better invest. It is a vastly better return on your investment, everybody, to invest into term life insurance policies. For the record, I have a pretty good term life insurance policy for myself. I'm going to invest into it for about 20 to 25 years. I am basically self-insured at this point in my life, because I've started investing into it in my early 20s, actually before I met my wife and long before I had kids. And at the end of I'm getting to the point now where I am kind of being close to I no longer need it. But That's my story. If you're 40 years old, listen to this, and you do not have any kind of life insurance policy, get one. And for my younger listeners that are listening, get a term life insurance policy as early as humanly possible. Why? Because if you are a non-smoker and you're 18 or 19, you get significantly lower interest rates for your life insurance policies than a 40 or 50-year-old person. And I'm saying that for this reason. I pay about $38 a month for my term life insurance policy. And because of that, I got that when I was about 18 or 19. Now, if I had waited until I was in my late 30s or early 40s, I would probably pay something closer to 75 or $80 a month. So yes, there is a portion of buying these policies, everybody, when you are young and you are still extremely healthy. Okay. So, as I said earlier, the first thing that you should not invest into, everybody, if you are serious about building generational wealth, is a whole life insurance policy. Because at the end of the day, they are only good for the individual that are selling it. They are not good in any capacity for you or for your family. On another level as well, too, if you are listening to this pod, if you listen to my live session right now, please support your content creators. Hit that dollar sign below. Please support your content creators. Show your support for our financial patients. Please show your support for your boy, because at the end of the day, this is a channel where I like to teach people essentially how to make money, how to save money, how to invest money. I drop weekly content every Sunday at 1 o'clock. So definitely check out my podcast, and please subscribe to the channel, and support your YouTube and these content creators. At the end of the day, everybody, we are running a business, and I thoroughly enjoy, once again, just pushing the ministry and the I would say just the methods and the methodology of building wealth. As I stated earlier, I truly do believe that individuals who become financially literate and financially free, that freedom goes to so many other different areas of your life. It goes into your relationships. It goes into the type of women that you pursue for my fellas. It goes to the type of women, to the men that you pursue for my ladies. It goes into the way that you raise your children. It goes into the way that you actually think about yourself in corporate America. It goes to the type of businesses that you start. Because at the end of the day, if you have no debt and you have no actual worries when it comes to money, it literally allows you to go after careers that you choose. And more important, it allows you to choose the type of life that you want to live, not not live a kind of life that you were forced to live. Okay. So as I said earlier, everybody, I truly do look at financial literacy as a ministry and as a blessing. And I think that in general, the more of us who become financially literate, the more of us who actually understand how money works, it's just gonna be better for the United States and better for our country in general. Okay. Additionally, another thing too, I also want to talk about as well in regards to the life insurance policy and stuff like that. I want to just once again hammer this home. If there is ever anything in the industry that is being pushed by the industry, I want you to seriously sit back and ask yourself why. Because generally speaking, if the industry is pushing anything, there's a reason why. And normally that reason is not in your best interest. Once again, there's a reason why the industries are pushing Forex. There's a reason why the financial industry is pushing crypto. There's a reason why the financial industry is pushing nothing down real estate. There's a reason why the financial industry is pushing high interest credit cards. There's a reason why you don't hear about things like REITs. There's a reason why you don't hear about things like total stock market index funds that track the S&P 500. There's a reason why you don't hear about index funds that essentially have high dividend ratios. There's a reason why you don't hear about the slow, boring investments, and the reason why is because those things that when they are being sold to you, the investors who sell them to, and the investment bankers who sell them to, and the hedge fund managers who sell them to, you cannot make a commission. So once again, everybody, keep in mind the average whole life insurance policy has an average rate of return of only 2.75%. The S&P 500 over the last 50 years has averaged 12%. In other words, if you invested in the S&P 500, you will make literally 10% more money over the course of your lifetime. Now, based off the rule of 72, if you're not familiar with that, you take the interest rate that you get, you basically divide it by 72. Based off of the law of 72, it would take you 36 years to double your investments essentially at a 2% interest rate. But at 12%, it would only take you 6 years. There's a reason, once again, people, why they sell you this garbage. Whereas, and the average total stock market index fund, once again, has returned roughly 11% over the last 50 years. Even in these terrible economic times and the recession that we're currently in, everybody, the total stock market index funds that I'm talking about and the exchange traded funds that I'm talking about, they have routinely averaged about 8 or 9% over the last year and a half. I'm sorry, over the last 9 months. And what's also interesting, people, is that when you actually step back and take a look at it, another reason why the financial industry and financial planners push whole life insurance policies so much is because they know for a fact when they get you, they essentially got you for the next 40 to 50 years of your life. Whereas with term life insurance policies, you dictate how long you actually want to be a part of that term. As I said earlier, when you have a fully stocked emergency fund, when you're maxing out your Roth IRAs every year, when you max out your HSAs every year, when you're maxing out your SEP IRAs every year, when you are basically putting $50,000 a month into your brokerage, $50,000 a year into your brokerage account, you are self-insured, and there's no permanent need for life insurance. That once again is a lie that is sold by the insurance industries. Okay. Next, the next investment. By the way, everybody, please support your content creators. Hit that share. I'm sorry, hit that share button. Also, just hit that dollar sign below. $1, $2, $20, whatever you feel like supporting your people with. And please ask questions. Okay, this is a live Q&A session. I thoroughly enjoy answering any financial question that you guys potentially have, and I thoroughly enjoy, as I said, pushing the communities forward in regards to building wealth, making money, and building generational wealth. Okay. So the next thing I want you to completely avoid at all costs is cryptocurrency. Now, this is an extremely controversial take because I can tell you right now, when I was on my channel pushing cryptocurrency, I would be getting sponsors left and right from um, meme coin, Bitcoin, the Trump coin, Dogecoin, all this kind of stuff. If you are a content creator on YouTube pushing crypto, you get at a significantly larger amount of sponsors than you do from the individuals like myself who go the boring slow route, which is paid off real estate, which is real estate investment trust, exchange traded funds, the S&P 500, and international stocks. If you push the boring stuff, I just get on saying, yeah, you get some sponsors, but you don't get the same kind of love. If I push absolute garbage that is bankrupting people every day, such as crypto, such as day trading, such as forex, I get people left and right saying, Chris, please promote our product on your channel. And at some point, you got to really sit back and kind of ask yourself, why is that? Because if the financial industries are pushing something that is beneficial for them and is not beneficial for you, at some point you have to sit back and ask the question, why? I want you to Google individuals like Sam Bankman-Fried or Ruja Ignatova or Carl Sebastian Greenwood. If you're not familiar with who these individuals are, they are essentially criminals, and I do literally mean criminals that have been convicted for stealing billions with a B dollars of people's money via their cryptocurrency wallets. Some of these individuals literally are looking at over 70 years in federal prison because of the things they were doing. And it's really sad because if you actually take a look at what crypto actually is, it's a software right, that's essentially backed by a digitally unprotected uh, item. And as a result of that, it's completely unprotected. And because it's digital, it makes it very, very, very easy to hack. Another issue with crypto, everybody, is that millions of people once again are having their accounts hacked and are losing billions of dollars because they are leaning toward their retirement accounts in something that is extremely risky. Once again, people, crypto is not backed by actual assets. It's not backed by gold. It's not backed by stocks. It's not backed by the FDIC. And in many cases, it's not backed by any credible government or asset. Now, having said that, I know just by talking about crypto, I'm probably going to lose a good percentage of people. Change that. Testing, testing. Can you hear me now? Can you hear me now? Testing, testing. Can you hear me now? Can you hear me now? Esther Paul, JTJ Trucking. Can you hear me now? All right, cool. Perfect, perfect. All right. Glad to hear that. Glad to hear that. As I said earlier, everybody, just crypto is one of those things. Like I say, I avoid it, avoid it, avoid it, avoid it. I can't tell you how many horror stories I've heard about people basically having $500,000 or $600,000 or $250,000 into their retirement accounts, and one of their nephews or their grandkids say, "Grandma, Papa, you should invest into crypto or invest in a forex, something like that," and they basically liquidate their 401k, which basically costs them about 40% of their 401k if they're under 60, if they're under 65. And when they liquidate the 401k, essentially, they lose 40% of what they have into it. Then they put it into something very risky like crypto. And by doing that, they expose themselves to tremendous risk and then they end up losing all of it. So 40 to 35 to 40 years of hard work is essentially lost because they got bad financial advice from a relative. And then they take that terrible financial advice, have to work at Walmart or become a sweet floors at McDonald's, become a Walmart greeter. And by doing that, they then run around and do something even more drastic, which they tell their family members and their kids don't invest in the stock market when crypto isn't even in the stock market. And I see this happen all the time in certain communities. And don't let that happen to you people. Crypto is one of those kind of things, like I said, we take a look at the tremendous risks that are associated with it. We take a look at the tremendous unknowns that are associated with it. We take a look at the fact it's not backed by anything. You are setting yourself up for a tremendous risk. Invest, therefore, into things that are significantly more reliable. Invest into the stock market, invest into the S&P 500, invest into the land, invest into the property, invest into yourself, invest into real estate, invest in real estate investment trusts, invest into exchange traded funds, invest into bonds if you want to. But crypto is one of those kind of things where it's not backed by credible sources. And so many people are losing money. And a lot of people are going to prison. Once again, take a look at Sam Bankman Fried, take a look at Ruja Ignatova, and take a look at individuals like Carl Sebastian Greenwood. Next. The next thing that you should not invest into, everybody, are options contracts. So this is another one of those things that unfortunately I'm seeing it pop up everywhere. And to me, it is the textbook definition of speculative trading. So everybody, options contracts, they give you the option to buy a stock at a predetermined price. And from there, you can sell that stock before a specified date. And in order to make more money on options contracts, you have to essentially first predict. First have to buy it when it's really low, and then predict how high it's going to be, and essentially sell it before, and essentially sell it at that height. Everybody, this is literally the textbook definition of trying to time the market. And by trying to time the market, you are setting yourself up once again to be a day trader and something that is extremely challenging to do. For instance, there are professional hedge fund managers, everybody, that have over 1,000 different investment bankers and mathematical actuarials on their staff. If you're not familiar with what that is, in order to be a in order to be a mathematician, in order to be an actuarial mathematician, you have to pass some of the most challenging, some of the hardest tests on the friggin' earth. I know individuals who have passed it, and those guys, generally speaking, are PhD type individuals when it comes to mathematics and reading stock markets and things of that nature. So if you are a basic investor, right, you're just Chris, or you're just Ryan, or you're just Buford, and you're trying to invest into the stock market and time the market, the individuals that you are competing against are essentially the type of guys that got engineering degrees, they got PhDs in mechanical engineering, they got PhDs in math and actual mathematics, got PhDs in finance, and thousands of them are employed by hedge fund managers whose job is to work 80 or 90 hours a week and try to time the market. Now, if you are competing once again against thousands of investment bankers that literally have PhDs in finance and PhDs in in engineering, do you really think you're going to beat them when it comes to trying to time the market? But that is exactly what you are trying to do if you want to be a quote unquote day trader. And options contracts, everybody, are essentially a glorified word for day trading because you're trying to time the market. Everybody, once again, options contracts are short-term investments, everybody, and they are at their utter worst. And historically speaking, long-term investors such as myself, who essentially buy a stock, we don't watch it every day, we basically buy a stock and just let it grow for 40 or 50 years, we make significantly more money than short-term investors for two primary reasons. First and foremost, we're not buying and selling our stock. which means you're not paying capital gains taxes on it. If you're not familiar with the capital gain is, when you buy a stock at a certain amount and you sell it at a higher amount, you make a profit. The federal government, Uncle Sam, always gets his. So he's going to charge you what they call capital gains taxes on the profit that you make. If you are a long-term investor like myself, you don't pay capital gains taxes because you buy a stock, hold it for 50 years, and then when you turn a certain age, once you pull it out, you've already paid the solid taxes on it. So as a result of that, everybody, by its very definition, you are going to lose money just for that reason because you're a day trader. Secondly, the amount of cash and the amount of money that you're essentially going to, and the amount of time you're going to basically waste, essentially trying to time the market is utterly insane. Once again, the average day trader and the average person, hedge fund manager that works for these companies works a minimum of 65 to 70 hours a week. When I was in grad school getting my MBA, finance was the route that I went. I thought for a brief moment of trying to go to Wall Street. And one reason why I decided to not go to Philadelphia's Wall Street was I had no desire to sit in front of a freaking spreadsheet for 80 to 90 hours a week trying to time the market. That was not something that I found very appealing. And but those are the kind of individuals you are competing against, and it's not just one. You are competing against an entire army of individuals that are like that. Another thing too, as a long-term investor, everybody, not only can you focus more on your life, I spend 1 hour a year in planning my investments because I basically automate everything. As a long-term investor, I prefer things to be simple. And if you are a long-term investor, they are extremely simple because you literally buy your stock, you put a certain percentage of it into the exact same boring ETF, the exact same boring real estate investment trust, the exact same boring total stock market index funds, the exact same boring type of precious metals, and the exact same REITs. Day after day, week after week, month after month, year after year, decade after decade. With stock options, you have to perfectly time the market. And they are therefore not only are they not simple, they're going to cost you lots of money when it comes to capital gains taxes. Before I go any further, everybody, please support your content creators. Once again, it's your boy Chris. I thoroughly enjoyed giving you guys free content here on Financial Patience. There's a lot of Q&A. So JTJ Trucking, Esther Paul, please ask me questions, fire away, because this is a session where I thoroughly enjoy opening up my Financial group to all my members, all my listeners. And I love answering any question that you guys have, whether it's about wills, whether it's about the stock market, whether it's about the S&P 500, whether it's about the current state of tariffs and things like that, how you should move. At the end of the day, everybody, I love opening up this session because I find in general, once again, teaching people financial literacy is something that I thoroughly, truly enjoy doing. And on top of it, it's also just really, really cool. Okay. It's really, really cool. So the next thing I would tell you to completely not invest into, everybody, are annuities. So this is essentially how annuities work. What's kind of cool about annuities is that they've actually been around since the Roman Empire. The earliest version of annuities that they have pretty much kind of been able to discover are the Romans. And the reason why is because essentially what happens was people were like, okay, if you're a Roman legionnaire and you're going to the combat, there's a very good possibility you could die. So pay into this amount. And then when you get killed in combat, your family's going to get essentially some money. That's kind of essentially the way that the annuities back in the ancient Rome worked. So this is the way they work in modern day times, okay? You give a very, very large amount of money, essentially, everybody, to you give a very, very large amount of money, everybody, to a certain bank, a certain hedge fund, things of that nature. And when you give that amount of money to it and things of that nature, you essentially have to, they send you a set amount of money at the end of every month once you are ready for retirement. Now, how does that actually work? How does it actually work? So you basically spend your entire life or a certain period of time basically paying into an annuity, and then when you get a certain age, typically 65, and that was probably gonna be 70 or 75 once the people hit once my age group basically hits annuities because the retirement age is rising, and they pay you a certain amount. One of the reasons why the industry pushes annuities, everybody, is because it helps their bottom lines. Similar to what I was talking about earlier in regards to whole life insurance policies, it helps annuities help pay their commission because every month you either talk to certain individuals, you either talk to certain investors and things of that nature, so they can send you a certain percent of the checks, and so they can talk with you about what kind of investments to make. And by doing that, you're paying very small fees and commissions on the things that you're doing. Now, if they say they're charging you 1% to help you manage your annuities, it doesn't sound like it's a lot. But think about this way. If you have a $1 million nest egg, right, and you working with an investment planner, an investment banker, and a retirement planner who essentially is charging you 1%, that means by the time you retire at 65 or 70 or 75, whenever you retire, you're only going to walk away with about $750,000. $750,000. roughly 25 to 28% of your money is eaten away in taxes and in fees if you go with financial planners that manage your annuities. So as a result of that, they, in my opinion, are not a very good investment because I would be pissed if I had $1 million, if I thought I had $1 million waiting for me to retire, so that me and my beautiful wife could retire in luxury, then I find out I only have $750,000. Or I will be extremely upset and pissed if thought I had $100,000 waiting for me in retirement, and then when I retired, I only had $75,000 waiting for me in retirement. That's how you essentially have to go back to work at Walmart to be a greeter or sweep floors at McDonald's. Okay, so be very careful about that. The industry once again pushes annuities because it helps their bottom line. It helps pay their commissions. It helps put their kids through college, but it's a lousy return for you. Most annuities, everybody, they don't take into account inflation, and the rate of inflation is 3%. That means if you have any investment in your portfolio that has returned less than 3%, like a whole like a whole life insurance policy on returns on average 2.75%, you are losing money. If you have an insurance policy that's returning 3.1%, inflation, everybody, is 3%. That means you are only making 0.1% money on your investment. People, if you spend 50 years of your life building a $3 million nest egg, why would you turn around and pay some hedge fund manager to basically manage your $3 million nest egg for you and to give you distributions when you clearly did a very, very good job, everybody, of building that wealth on your own? And that is my issue once again, everybody, with annuities. Because once again, if you spent 50 years doing the right thing and building your money, why in the world do you need to turn around and pay somebody to teach you how to distribute that money when you get old? I don't get it. So as a result of that, as I said earlier, do not invest into annuities. Let it die with the Roman Empire. Okay. Next, the next thing you should absolutely not invest into, everybody, are penny stocks. So penny stocks, everybody, are made up of companies that trade for less than $5 of their market share. Now, why is that important? Because the concept behind a penny stock, everybody, is that if you put $5 into a quote unquote failing stock, if it's a good stock, at some point it's going to go up. And if you buy a stock at, let's say, $5 and it basically goes to $50, voila, you make $45 a stock. So it sounds good. And at the end of the day, most people can afford a $5 stock. I mean, that's not even a that's not even a Happy Meal at McDonald's. So most people can afford a $5 stock. So typically, what I find is that penny stocks typically appeal to the financially illiterate people that are trying to get better at stocks. And somebody comes up to them and says, "Yeah, I can sell you the stock for $5 and I think it's going to go up." So as a result of that, people who don't have a lot of money or a lot of financial literacy buy into them. And as a result of that, unfortunately, they are basically buying into what I would like to call very cheap, poorly managed stocks that typically are not going to do very well. And you're basically wasting your time and your energy investing into them. Once again, everybody, it's your boy Chris. Please support your content creators. Hit that like, comment, share, and subscribe button. I drop weekly content every Sunday around 1 o'clock. And definitely hit that dollar sign below. Okay. If you're interested in supporting the channel, my cash app is dollar sign CHRISP 45. And this is a live Q&A session. So by all means, everybody, please ask questions. Please fire your questions away, okay? So to get back to penny stocks, as I learned, most companies that sell for under $5 a share, everybody, I'm just gonna keep it a buck. They're typically, as I said, trashing companies that are basically poorly ran. And why invest into a company that's being poorly ran? I mean, there's a reason it only costs you $5. As a long-term investor, I once again invest into things that are simple. They have a very long track record and have a very proven rate of return, like the total stock market index fund, like the S&P 500, like real estate investment trust, like international real estate investment trust, like international total stock market index funds. I like to invest in things that once again are simple, that once again are easy, and that once again have a proven track record. And penny stocks, they don't do that. They're very risky, they're very volatile, and they probably won't be around in 2 years. So why invest your money into something that probably is not going to be around by time Christmas rolls around? Let's bring out what you think. Next. The next one is also extremely controversial because this one literally has an entire industry and some extremely very, very popular Asian guys who invest into it. He probably heard he talks about his two fathers that he had and stuff like that. And he just pretty much swears by it and how he taught him how to be rich and one time how to be poor and all that kind of stuff. And this one is gold. Now, precious metals are a very interesting thing because full disclosure, I actually do invest a little bit into precious metals because some of my stocks actually have a portion of it with it. They follow a gold index, and there are some good benefits about gold. The first thing I say is this: Gold is a very good hedge for inflation. Gold has a very proven track record. Human beings have been rocking gold literally since the friggin' Babylonians and the Medes and the Persians and the ancient Egyptians back in the day when they were building pyramids. So gold has a proven track record, and on top of that, it also it's a hedge against inflation. Supposedly, if it hits the fan and things go really bad and stuff like that, and World War III starts and everybody's in Walking Dead kind of scenario, you're gonna be able to have gold, and it's gonna basically be your essentially your saver to basically buy and sell. That's what they tell you. I personally truly believe that as a licensed firearms instructor and a licensed firearms owner, that if you are in a situation where all of us, where the world is collapsing, things like that, by having that Uzi is probably gonna be a little bit more effective than having gold. But I'll just leave. I'm not really gonna. I'll just leave it at that. Okay. Having said that, gold is a lousy investment for a couple of reasons. The first reason and biggest issue I personally have always had with gold is that where exactly do you store it? If you live in areas like Beverly Hills in Los Angeles, if you live in like State Street in Chicago, if you live in like Brooklyn, Miami, or Manhattan in New York, Oahu, Hawaii, and places like that, real estate is extremely expensive. To some extent, it can be over $5,000 per square foot. So if you got $1 million of gold just laying around in your apartment or laying around your house, that's A, not very safe, and B, it takes up a whole bunch of space. And it's not like you can just tell the movers to show up and just start moving stuff because you're going to attract very, very unwanted attention to yourself. So as a result of that, gold is a very risky investment because at the end of the day, where do you store it? It takes up a lot of room and it's very heavy. Secondly, the average rate of return for gold, everybody, is only about 6%. Now, on its onset, it's actually not bad because the average mutual fund manager and hedge fund manager can only return about 4.5% over the last 50 years. So, as a result of that, gold actually does have a better return than a lot of these trash investors that you see that are giving you financial advice on the Motley Fool, Fox News Money, and places like that. But at 6%, it is literally doing half as good as the S&P 500 and almost half as good as a total stock market index fund. So with gold, you're investing into something that you have to store, that you have to protect, and that you can't let people know that you have it. But when it comes to the actual investments that come with it, it's kind of not worth it because you make actually more money on the S&P 500 just investing into basic stocks. As I said earlier, I am not 100% against precious metals. I do think that in some ways that having them are actually relatively good, and I think it's a decent part of any portfolio. But the idea that you should put 100% of your investments into gold is very stupid. Or into any precious metal, I believe is extremely stupid. Why? Because the rate of return is lousy. It has a very, very poor track record over the last 50 years compared to stocks. And then on top of that, you have to store it somewhere. And yes, it is a hedge against inflation, but you know what? Real estate is a hedge against inflation. Property and land is a hedge against inflation. And to me, those are a lot less stressful to own. As I said earlier, you can kind of do what you want to do, but when it comes to lousy investments that I tell people to avoid, do not make gold a tremendous portion of your portfolio because if you do, it's going to put you in a world of pain. Okay. Next. The next investment that I believe that you should completely, utterly, to some extent, ignore is any financial planner or any individual or institution telling you to invest into their services. Now, before I go any further, once again, everybody, please support your content creators. It's your boy Chris. Hit that like, comment, share, and subscribe button as I drop weekly content. And on top of that, as well, hit that dollar sign below. $1, $5, $2. It goes very well. And on by all means, everybody, please by all means, everybody, please definitely support your content creators. Okay. So why do I say investment managers and people like that are people you should avoid? It's for one very simple reason. If you take a look at what an investment manager has to do, especially when it comes to investing your money, their job is not actually to make you money. Their job is to sell you products that they're being paid to tell you to buy so their company they work for can make money. That is kind of scary when you think about it, because in America, we're programmed to think that generally speaking, if you pay a lot more money for something, you're getting a better product. Whether that's an automobile, whether it's a piece of steak, whether that's a personal trainer, whether it's a house that you buy. Generally speaking, in America, the more money that you spend for something, the better that you're going to get, or at least or at least that's what you're taught to think. With investment bankers and investment managers and things of that nature, there is no actual correlation to how good they are to how much they charge you. Perfect example. 96% of investment bankers over a 10-year period cannot return over 5%. The stock market over a 10-year period returns roughly 10 to 12%. In other words, if you invest into a basic, boring stock market, a basic, boring total stock market index fund that tracks the S&P 500 or that tracks all 2,500 or 3,000 stocks in the U.S. stock exchange, you're going to make nearly twice as much money. 99% of investment planners cannot return over 5% over a 15-year period. So why in the world are you going to invest into somebody that essentially cannot beat the stock market when you can invest on your own and and make significantly more money? That's the first thing. Secondly, if you're paying an individual, a mutual fund managers, things like that, to essentially buy and sell stock for you, people, what that means is that every time they buy a stock and they sell a stock and they make a profit on it, you have to pay capital gains. And by paying capital gains, you're essentially paying more taxes for an inferior investment that only returns about 5 or 6%. Oh, and I also have other news for you. If you are investing with a hedge fund manager or a mutual fund manager, another issue to deal with is this: what benefit do they actually have to make you money? Now, yes, there are some investment planners out here that literally, if you don't make any money, they don't make any money. And those are a little bit better. But in general, once again, when you work for an investment plan, if you work for a company or for an investment bank or for a hedge fund manager or for a mutual fund manager, they are literally wined and dined by certain industries to basically sell their stock. And because they are wine and dine by certain industries to sell their stock, similar to our medical professionals, they essentially have to sell you a certain percent of the stocks that they are being paid to sell you. In other words, they're not being paid. They're not being paid to sell you things that are actually going to make you money. They're being paid to sell you things that are actually going that they're being forced to sell you so they can basically make their commissions. Secondly, the only way you make money as a financial planner is if you basically get your commissions. So if there's a stock that I know that's going to make you, let's say, 12% over the next 50 years, and all I need to do is tell you that one stock one time, I'm not going to make any commission after I tell you to sell it. But if I can continue to introduce brand new investments to you, brand new stocks, brand new mutual funds, brand new bonds, brand new annuities, essentially, those are going to make me a commission every month. So as a result of that, there is no benefit to me actually telling you the things that work. My benefit is to tell you things that are gonna force you to pay me a commission every time I see you. And the last thing I'll say is this: if you really want to blow your mind, do this. Ask the managers and the hedge fund managers and the mutual fund managers who essentially are selling these products, do they actually invest into themselves? Because 95% of investment managers, hedge fund managers, and mutual fund managers don't even invest into the things that they tell their clients to invest into. When people ask me why I quote unquote decided to work in an industry engineering that's to some extent different from finance, that was one of the reasons why. Because I found it very challenging to look my clients in the face and sell them a product, a financial product that is, or a stock that I myself did not believe in. I found it very difficult to try to tell people to buy things that I knew would not make them a lot of money because my company was forcing me to buy that. And I also found it extremely challenging, everybody, to work for a company that told me they would fire me if I did not sell the type of garbage that they were telling me to sell. And I have investment banker friends and mutual fund manager friends who are in that exact same situation. They have told me straight up, Chris, I cannot tell people to buy that stock or to buy that index fund or to buy this particular real estate investment trust because if I do, they're going to fire me. I know people that are like that in the industry. And that's one reason why I've always looked at the finance industry to some extent a little sideways. And the last reason why is this: prior to me getting my MBA, when I was a very, very young engineer, I was talking to a guy who recommended a certain stock to me. And I invested very heavily into that stock for most of my 20s. When I graduated at 28 years old with my MBA, and I actually understood how the stock market really works, how to read a stock, how to read the dividend ratios, how to read the expense ratios, how to read the history of the stock and things of that nature. I was blown away that this individual would recommend a stock to me that basically returned less than 1.3%. So imagine if I had spent all of my 20s investing to a stock that basically returned about 12%, like the S&P 500, and not this absolute garbage account that this individual recommended to me when I was a very young mechanical engineer. It literally would have changed my entire financial tree. Financial literacy, everybody, is freedom. But the sad part about it is, like so many other things in America, that freedom is not truly offered to you if you don't understand the way the game is played. And if you continue to allow people to invest your money for you, you have absolutely no idea what they are doing with that money. It is not in your best interest, everybody, as a responsible citizen. If you don't believe me, one reason why 50% of athletes used to go broke in the 1990s, 1980s, and the early 2000s is because they were doing the exact same model where they were giving all their money to people who may or may not have looked like them, who had PhDs, who had master's degrees, who had MBAs and all that kind of stuff. And those people were investing, making absolutely horrible investments with Allen Iverson, Kurt Schilling, and Adrian Peterson's money. And when Adrian Peterson and Allen Iverson and Kurt Schilling all went broke, we laughed and made ESPN documentaries about these individuals. We called them stupid and said they're another dumb, you know what, that didn't know what they're doing with their money, another stupid athlete that went broke. But you know what's crazy? Those MBAs and those investment managers and those hedge fund managers, they're still around today. They got gray hair. They're in their 50s and their 60s, and they're still giving trash bag advice to individuals who aren't just not professional athletes. They're lawyers, they're electricians, they're doctors, they're engineers, they're teachers, they're mathematicians, they're scientists, and they're janitors. People understand how finance works, understand how financial literacy works, understand what you should not be investing into, and understand what you should be investing into. Okay. So with that, we open the floor for our bounce. Questions, comments, anybody? You got anything you want to ask me? Because once again, this channel is all about making money. It's all about saving money. It's all about building generational wealth, and it's all about financially emancipating yourself from generational poverty. I thoroughly enjoy everybody teaching you essentially how to make money. I thoroughly enjoy teaching you everybody how to essentially improve your financial literacy. And I thoroughly enjoy teaching you guys essentially pitfalls to avoid and the pitfalls and things that like that to completely skip so that you do not end up like a lot of the unfortunate individuals who are around you. Okay. Fire away, fire away. Questions, comments, fire away. Also on this long weekend, I believe with it being Columbus Day or Indigenous Peoples Day, if you guys are going to be celebrating, please celebrate responsibly. So yeah, going once, going twice. JTJ Trucking. You business owner? Tell me a little about your business if so. All right, cool, cool. Once again, everybody, it's your boy Chris. You can check out my content, Financial here on Financial I try to drop weekly content every Sunday. I'm probably gonna start going at 1 o'clock, just because I think it's kind of a little bit better time. Additionally, everybody, additionally, everybody, please check out some of my digital and e-products as well below. I have a financial blog where I go into a lot more detail about dynasty trusts, HSAs, real estate investment trusts, the 4% rule, my honest thoughts on forex, my honest thoughts on crypto, and there's different things that you can do essentially to build your generational wealth. Please check out my website, www.therealfinancialpatient.com. Check out my Instagram, the real underscore financial patient. My Spotify is financial patient. My TikTok is financial patient. And my Facebook page is financial patient. Additionally, check out my financial blog, as I said earlier. Please check out my scholarship book where I tell you how I went to undergrad and got over $300,000 to get my engineering degree for free. If I went to college for free, so can you. And additionally, everybody, once again, please like, comment, share, subscribe, hit the algorithm, hit the notification button, okay? Because I drop new content. And once again, it's your boy Chris. I'm out. I'm out. Peace. Peace.